It's been no secret that fintech has been one of the hottest sectors over the past few years and one of the greatest beneficiaries of the capital that flowed into the tech ecosystem over the last few cycles. And we've also witnessed companies reaching remarkable scale with over 334 fintechs reaching unicorn status, that is, achieving $1 billion valuation. Now, back in 2013, achieving $1 billion valuation only happened 4 times a year, but as of 2022, almost 2 new unicorns were born every day. This rare occurrence has now become more commonplace, and financial services or fintech are the second biggest industry where the most billion-dollar valuations can be found. Now, these high valuations beg the question: are investors placing too much emphasis on potential rather than real value? It's a question that looms over the fintech landscape as we navigate the recent era of unprecedented growth. And while we've seen incredible successes, we've also seen significant failures. The burst of the fintech bubble, if you will, has left many questioning the sustainability of such high valuations. Investors are becoming more cautious, and startups must now prove not just their potential, but their real tangible value. So what truly defines the value of a fintech startup? Is it the technology, the user base, the revenue model, or something more intrinsic? So in this video, we'll dive deeper into these aspects and understand how they shape the overall worth of these companies. We'll look into the differences between the valuation and the actual value of fintech startups. We'll try to ascertain how value is determined, and we'll try to take a look at how we achieve such an overflow of investment into the fintech startup space, creating the massive influx of unicorns who down the line saw a meteoric drop in valuation. If that sounds interesting to you, then let's chat about it. Hello friends, welcome back to the channel. My name is Jeremy, and if you're new here and haven't yet subscribed, please consider doing so, because on this channel I speak about fintech, digital transformation, and agile strategy. Now, before I jump in, I just want to say a massive thank you to everyone who has subscribed, watched, liked, commented, and shared my videos. We crossed the remarkable milestone of 10,000 subscribers early on this year, which is a great feat for a niche channel like this. So I want to extend my sincere gratitude and appreciation to everyone who has taken time out of their day to hit the subscribe button and continue to watch these videos, especially those within the family who have been with me since day one. Massive thank you. Now back to the topic. Now, on the subject of the difference between fintech startups' real value and its valuation, it's quite a fascinating one. But before we jump into it, let's take a moment to reflect on some of the cautionary tales that have unfolded in the past. Think about those unicorns that soared to incredible valuations only to come crashing down in a matter of years. We've seen this happen time and time again, with some of the most promising fintech startups meeting an untimely demise. Think Theranos, WeWork, or even the infamous Wirecard, all once deemed unicorns but now etched in history for very different reasons. Now, to understand the difference between value and valuation, we need to break down what each term means. Valuation in simple terms is the monetary worth assigned to a startup by investors and the market. Let's imagine a high-end sports car. Valuation is like the sticker price set by the dealership or the price tag in the market. This price is influenced by factors like the brand's prestige, the car's performance specs, and its potential future value. It's often what people are willing to pay based on its brand reputation and market trends. Value, on the other hand, is more intrinsic. It's more like the driving experience you get from the car. It's the thrill of accelerating on an open road, the comfort of the leather seats, the precision of the steering, and the advanced safety features that keep you and your passengers secure. The intrinsic value is about how well the car performs and how much joy it brings to you, how reliable it is over time. It encompasses the actual benefits and utilities a startup provides to its users and the robustness of its business. Now, in the context of a fintech startup, valuation is a price tag that is set by investors, often based on potential market size, future growth prospects, and investor sentiment. Value is the real practical benefit the startup offers to its users, the robustness of its technology, and its ability to generate consistent revenues and growth. Now, just like the sports car, the true value lies in the experience and benefits it delivers, not just the number on the price tags. Now, valuations are often driven by metrics such as the revenue multiples, so how much revenue a company generates and how that scales over time. Also, the user growth, the rate at which a startup is acquiring new users or customers. There's also the market potential, the size of the market a startup operates in and its growth potential. Also, the competitive landscape, which is how well a startup can defend its position against competitors. Now, on the flip side, the real value of a fintech startup might be gauged through customer satisfaction, which is the degree to which users are happy with the product or service, or the operational efficiency, which is how effectively the startup uses its resources to generate profit. Also, sustainability, the startup's ability to maintain its business operations over the long term. Innovation, which is the extent of innovative solutions and technologies the startup brings to the market. Now, the fintech sector, like many tech-driven industries, is subject to the hype cycle, which is a pattern of inflated expectations followed by a trough of disillusionment. Now, in initial stages, a new technology or business model can generate tremendous excitement and investment, driving the valuations sky high. However, once the reality sets in, and the startup has to deliver on its promises, many struggle to meet those expectations, leading to a significant drop in valuation. Theranos promised a revolutionary blood testing technology but failed to deliver on its claims. Its valuation skyrocketed based on potential, only to plummet when the technology was revealed to be non-functional. Even though WeWork is not a fintech, its story is still relevant. Its valuation was inflated by rapid expansion and charismatic leadership. However, the lack of a sustainable business model led to a significant devaluation. Wirecard was once a star in the fintech world with its innovative payment solutions. However, it collapsed due to fraudulent accounting practices, highlighting the risk of overvaluing growth and market reach without robust financial scrutiny. Even in Africa, in the last couple of years, we've seen several cautionary tales of some high-flying techs that secured large funding rounds but later struggled to maintain operations. Sendy is a logistics fintech company that secured substantial funding. Sendy faced substantial financial difficulties in 2023, leading to massive layoffs and an announcement of acquisition by an undisclosed buyer. Copia is an e-commerce fintech hybrid, and Copia raised $50 million in a Series C round in 2021. By 2023, the company closed operations in Uganda, laid off 20% of its workforce due to economic downturns and constrained capital markets. Kune Food is a startup aiming to revolutionize the ready-to-eat meals market. Now, despite raising $1 million in a pre-seed round in 2021, it shut down operations in 2022 due to financial difficulties. Now, these cases illustrate the volatile nature of the tech sector, where significant funding rounds do not always guarantee long-term stability and success. Now, in recent years, many tech and fintech startups managed to raise huge and significant funding rounds, sometimes based on an idea or prototype alone, and there are several reasons why that happened. The first is the allure of disruption. Fintech startups often present themselves as disruptors of traditional financial systems, offering innovative solutions that promise to revolutionize banking, payments, lending, and insurance. The potential to upend a centuries-old industry captivated investors who were eager to back the next big thing. Also, the digital transformation wave, accelerated by COVID-19, highlighted the immense potential of digital financial services. With a large unbanked population and increasing smartphone penetration, fintech companies were seen as having a vast untapped market ready for rapid growth. And then also the high returns in tech. The tech sectors, including fintech, had produced some of the highest returns for investors over the last decade. Companies like PayPal, Square, and Stripe demonstrated the lucrative possibilities, encouraging investors to seek similar opportunities in emerging markets. Now, during the peak of the fintech boom, investors operated with a particular mindset. One, there was a fear of missing out, which led to aggressive funding as investors rushed to get in early on the next potential unicorn. Two, investors often prioritize growth metrics and potential market size over immediate profitability. The idea was that capturing market share quickly would eventually lead to substantial profits, even if the company was not yet profitable. Also, the promise of high returns justified a higher tolerance for risk. Investors were willing to back bold, unproven ideas with the hope that a few big wins would outweigh the inevitable losses. Recently, as we've seen, however, there has been a noticeable pullback in investment into the fintech space, and several factors have contributed to this shift. For one, global economic conditions have become more uncertain, with rising inflation, increasing interest rates, and geopolitical tensions. This has made investors more cautious, reducing their appetite for high-risk investments. 2. Investors are now more focused on sustainability and profitability. The days of funding startups based solely on user growth and potential market size are waning. There's a greater demand for clear paths to profitability and solid business fundamentals. Also, the market is correcting. Many high-flying fintech startups have struggled to live up to their lofty valuations. High-profile failures and scandals have made investors wary, leading to more stringent due diligence and a re-evaluation of what constitutes a viable investment. The collapse of SVB, Silicon Valley Bank, and other financial disruptions have created a funding winter where access to capital has become more restricted. Startups are finding it harder to secure large funding rounds, leading to a more selective and conservative investment approach. In this new investment climate, the approach has shifted significantly. Investors are looking for startups with strong business models, proven revenue streams, and clear paths to profitability. The emphasis is on sustainable growth rather than rapid expansion. There's also greater emphasis on due diligence. Investors are scrutinizing financials, operational efficiency, and market potential more closely to ensure they are backing viable ventures. The focus has shifted to long-term viability and resilience. Startups that can demonstrate the ability to navigate these economic downturns and adapt to the changing market conditions are most likely to be the ones to secure funding. So the future of fintech is still undoubtedly bright, with continuous innovations and increasing adoption of digital financial services. However, the journey to achieving a balance between high valuations and real value is still ongoing. Startups and investors alike must learn from the past mistakes and strive for sustainable growth. This shift reflects a maturing market where the focus is on sustainable value creation rather than speculative valuations. I hope you found this video valuable, and if you did, remember to hit the like button and leave me a comment. Thanks for watching, and I'll see you in the next video. Cheers, guys.